This is a breaking story episode, so before we begin, details can change fast and competing claims will flood the feed. In this video, we separate confirmed reporting from political statements, and we focus on what markets do when the world feels like it's tilting. Now, picture the moment the headlines hit. Not a rumor about elections, not another sanctions threat. A direct kinetic U.S. strike inside Venezuela, and claims that Nicolás Maduro was captured and flown out of the country. Whether you see this as liberation or aggression, markets don't wait for moral debates. Markets react to uncertainty. And the moment geopolitical risk jumps from possible to real, money moves like it smells smoke. That's why silver, yes, silver, not just gold, has been ripping through levels, with spot prices pushing toward the psychological line of $75 an ounce. 75. A number that would have sounded insane to most people not that long ago. So tonight, we're going to do this properly. What likely happened, what's verifiable, what's still contested, and why the metals complex is acting like a pressure cooker. Then we'll zoom out, Fed expectations, the dollar, real yields, and the plumbing of the silver market that almost nobody talks about until it breaks. Because in every crisis, there are two wars, the one on the ground and the one inside the balance sheets. Start with a geopolitical shock. Venezuela isn't just a country on a map. It's a node in the global energy and influence network. It sits on massive oil reserves. It's been a proxy battleground for sanctions and alliances, and it's tied into broader tensions involving the US, China, and regional powers across Latin America. When the US conducts a military operation on that soil, the first-order market reaction is simple. What's next? What does retaliation look like? What happens to oil flows, shipping insurance, regional stability, supply chains, elections, cyber escalation, and commodity corridors? Even if the physical supply of silver hasn't changed by 1 ounce, the demand for protection changes in an hour. That's what safe haven really means. It's not a place, it's behavior. It's a stampede out of maybe tomorrow and into right now. Now here's the key. In a fast-moving event like this, you will see 3 layers of information. Layer 1, official statements, often designed to control narrative. Layer 2, live reporting, often accurate but incomplete. Layer 3, social media, fast, emotional, and frequently wrong. The job of a serious channel is to tell you which layer you're looking at. So we'll treat the claim the way markets do, as risk, not as gospel. Because even if later details change, the volatility spike already happened, and volatility is what moves metals. Now, why silver specifically? Most people still think of silver as the little brother of gold. But silver is weird. Silver is a monetary metal with an industrial heart. It sits at the intersection of fear and function. In normal times, that makes it choppy. In crisis times, that makes it explosive. Gold is the classic sleep well asset. Silver is the hold-on asset. When risk sentiment flips, silver can gap up harder because it's thinner, more volatile, and often more crowded when everyone tries to squeeze through the same door. So the move to $75 isn't just about panic. It's also about structure, inventories, positioning, and a market that's been tightening underneath the surface for months. And when a geopolitical catalyst hits a structurally tight market, you don't get a gentle rally, you get a snap. Think of it like a metal spring that's been compressed. It doesn't climb, it releases. Here's the first big takeaway for part 1. The Venezuela shock is the match, but the silver market was already soaked in gasoline. Tight physical flows, rising investment demand, heavy industrial pull, and the constant question, is paper silver the same as real silver? That question sounds niche, but in a panic it becomes everything. Because in a panic, people don't want exposure, they want delivery. They don't want a promise, they want a bar. And the moment enough participants ask for the same thing at once, the price doesn't reflect value, it reflects availability. That's how you get violent headline-driven moves that leave technical levels looking like speed bumps. Now let's anchor ourselves. What does $75 mean psychologically? It means we've entered a zone where the average person starts paying attention and the average institution starts rebalancing. Funds that ignore silver at $25 suddenly have mandates at $75. Risk managers start asking questions. Producers start hedging. Shorts start sweating. And retail? Retail arrives late, emotional and loud. Which is why the next phase is always the most dangerous. After the first spike, you often get a shakeout that feels like it's over, right before the trend resumes. That's why we're not here to scream on $100 tomorrow. We're here to map the battlefield, levels, catalysts, and scenarios. Because if this story escalates, silver can overshoot anything that looks reasonable. And if the story de-escalates, silver can still stay elevated if the underlying squeeze is real. In other words, geopolitical risk can start the fire, but market structure decides how long it burns. So in part 2, we're going into the silver plumbing. COMEX versus London, inventories, premiums, and why paper can trade one price while physical trades another. And once you understand that, $75 stops looking like a random headline number and starts looking like a symptom. Let's pull the curtain back on the silver market, because this is where most commentary becomes theater. People shout about charts, but the real story is the pipeline. The path metal takes from mine to refinery to vault to end user, and the promises built on top of that metal. Silver trades in two worlds at the same time, the financial world and the physical world. The financial world is liquid, fast, and often leveraged. The physical world is slow, constrained, and brutally real. When those two worlds agree, price moves make sense. When they diverge, you get dislocations, premiums, delivery stress, backwardation, and sometimes outright squeezes. Start with the basics. The benchmark price you see quoted, spot silver, is heavily influenced by futures and large OTC trading. In practice, a huge amount of silver trading is not bars changing hands. It's contracts, exposure, claims. That's not inherently evil. It's how modern markets provide liquidity. But it creates a vulnerability. If too many participants want physical settlement at once, the system gets stressed. And stress is exactly what geopolitical shocks create. In calm periods, traders are comfortable rolling contracts. In crisis periods, they suddenly care about counterparty risk, settlement risk, and whether the metal is actually there. That's when the old question comes roaring back. If everyone asked for delivery, could the market deliver? Even the perception of strain can move price, because perception changes behavior. Now think about what S happening as silver pushes toward $75. First, margins and volatility rise. That forces weak hands out. Second, liquidity fragments. Some players step back, spreads widen, and price can jump harder on less volume. Third, physical premiums can detach from spot. You might see headlines saying silver is $75, but someone trying to buy coins or small bars pays $80, $85, maybe more depending on supply. That gap is the market telling you something. It's not just price, it's availability and distribution. The bigger the fear, the more people prefer the simplest form of ownership. And the simplest form of ownership is not a derivative. It's metal in hand or metal in a reputable allocated vault. This is where the safe haven demand idea becomes concrete. It's not just investors buying an ETF. It's industrial buyers protecting supply. It's wholesalers rebuilding inventory. It's funds hedging tail risk. And it is ordinary people doing the oldest trade in history, swapping uncertain paper for tangible metal. Now layer in the industrial side, because silver is not just a monetary relic. Silver is a critical material. It goes into electronics, solar panels, medical applications, chemical catalysts, and a long list of components that modern life quietly depends on. When supply chains feel threatened by war, by sanctions, by shipping disruptions, industrial demand becomes inelastic. That means buyers are less sensitive to price because they can't easily substitute. If a manufacturer needs silver to fulfill contracts, they will pay up rather than shut down. That's crucial. Gold doesn't have that same industrial pull. Gold demand rises mostly from investment and jewelry. Silver demand rises from investment plus industry. So when fear rises and industry remains strong, silver can get squeezed from both sides. Investors want it as insurance and industry wants it as input. That is the perfect recipe for a sharp move. Now let's talk about inventories and the warehouse narrative. In futures markets, the idea of registered and eligible inventory matters. Without getting lost in jargon, here's the point. Not all vaulted silver is immediately available for delivery against contracts. Some is earmarked, some is owned, some is simply stored. When delivery demand increases, the deliverable pool can look thinner than the total vault numbers suggest. And when traders see tight deliverable inventory, they front run the stress. They bid up the price, not because they love silver, but because they fear the scramble. That S, when the market behaves less like a commodity and more like a game of musical chairs, the price jumps because nobody wants to be the last person holding a paper claim when the music stops. Now add the geopolitical catalyst. A U.S. strike and a leadership capture claim is the kind of event that makes institutions ask, what if sanctions expand? What if energy prices spike? What if the dollar whipsaws? What if risk assets gap down? In that environment, metals get a bid, but silver gets a special bid when the market is already tight. That's why you can see a move that feels outsized. You're not watching a smooth repricing. You're watching positioning and stress collide with fear. Here's a practical way to understand it. Think of silver as a narrow bridge between two cliffs. On one cliff, you have monetary demand, people buying because they distrust the system. On the other cliff, you have industrial demand, companies buying because they need the material. When calm prevails, traffic across the bridge is manageable. When panic hits, everyone tries to cross at once. The bridge doesn't get wider, it just gets crowded. Price is the toll that rations who gets through. And at $75, the toll is rising because the crowd is bigger. So what comes next? In part 3, we connect the plumbing to the macro engine, the Fed factor, the dollar dynamic, real yields, and why rate cut expectations can pour gasoline on a metals rally. Because the silver squeeze story is real, but macro decides whether the squeeze becomes a supercycle or a spike followed by a brutal reset. If part 2 is the pipes, part 3 is the pump. Because metals don't just move on fear, they move on the price of money itself. And the price of money is set by expectations. What the Fed will do, what inflation will do, and what the dollar will do when everyone tries to de-risk at the same time. In a geopolitical shock, the first reflex is risk off. Stocks wobble, volatility rises, credit spreads widen. But the second reflex is more subtle. Traders start pricing in policy response. If a crisis threatens growth, central banks often lean dovish to stabilize conditions. That's why you'll often see metals bid, not only because of fear, but because of the expectation that real rates will fall. And real rates, interest rates after inflation, are the gravitational field of precious metals. When real rates fall, the opportunity cost of holding non-yielding metals falls too. Gold and silver don't pay interest, so when safe bonds pay less in real terms, metals become more attractive. Now add the dollar. The dollar can do two different things in a crisis. Sometimes it surges because it is still the world's primary liquidity instrument. People need dollars to pay debts and settle trades. Other times, the dollar weakens because the crisis is US-centric, or because traders believe the Fed will cut faster than other central banks. In this case, because the shock is directly tied to US action and global diplomatic blowback, you can easily get a whipsaw, a knee-jerk USD bid followed by policy repricing and a softer dollar. Metals love a softer dollar. If the dollar rolls over while fear remains elevated, that's a powerful tailwind. Now here is where silver gets interesting again. Silver West volatility means it often lags gold at first in a pure panic, then catches up violently when traders rotate into higher beta havens. Gold is the first stop. Silver is the second wave. Once gold is moved, the narrative becomes silver is undervalued versus gold, and the silver-gold ratio becomes a headline. Funds and speculators love ratios because ratios feel like math, and math feels like certainty. In reality, ratios are just another way to express positioning, but the effect is real. When the silver-to-gold ratio shifts, it can pull a lot of capital into silver fast, and at $75, that rotation is already in motion. Now zoom out historically, because Money and Empires is not just about today's chart. It asks about the repeating pattern of power, debt, and crisis. Every empire eventually faces the same equation. You can't print confidence. You can only borrow it until the bill comes due. In 1971, the monetary world changed when convertibility rules broke and money became more explicitly political. In 2008, the world learned that the financial system could freeze overnight and central banks would create liquidity at a scale nobody imagined. In 2020, the world learned that emergencies justify extraordinary policy and temporary measures have a habit of becoming permanent. Each event trained investors to expect one thing. When stress spikes, policymakers will choose stability over purity. That expectation is why metals keep returning as insurance. Not because everyone thinks fiat currency will vanish tomorrow, but because everyone has watched the rulebook get rewritten in real time. Now bring that back to Venezuela. A dramatic intervention triggers global arguments about sovereignty, legality, and escalation. Allies condemn, rivals react, and the risk of secondary consequences rises. Sanctions, energy retaliation, cyber moves, shipping disruptions, political blowback. The market doesn't need certainty to price this, it needs probability. Even a small probability of a larger conflict can reprice insurance assets sharply. That's why safe haven demand can explode even before the first real economic data prints. But data still matters, because the next catalyst after the headline is always the calendar. If economic numbers weaken, rate cut expectations intensify. If inflation surprises, yields can jump and metals can get punched in the face temporarily. This is why the week after a shock is often a battleground. Headlines versus data, fear versus math, narratives versus rates, and silver lives right in that collision zone. Here is the big mental model for part 3. Silver's move to 75 is not just people are scared. People are scared in a world where the price of money is expected to get cheaper. Fear plus easier money expectations equals rocket fuel for precious metals. But there's a catch. Silver also trades like a risk asset at times. If markets crash hard and liquidity disappears, silver can drop with everything else in the initial liquidation, then rebound harder later. So you have to be ready for two phases, the spike, then the shake. The story isn't linear, it's a storm. In part 4, we get tactical. The key technical levels, the psychology around $75, the prior highs, the support zones, and the 3 scenarios that matter, breakout, consolidation, and rug pull. Because if you're going to narrate this like a pro, you don't just describe the fire, you map the exits. Let's talk technicals, but the right way, not as magic lines on a screen, but as crowd psychology made visible. Technical levels are not rules. They're places where a lot of people made decisions, got trapped, or made money. That's why price reacts there. And when silver's trading in the 70s, psychology is amplified, because every dollar is a headline. First, the obvious line, $75. Round numbers act like magnets in battlegrounds. Bulls see $75 as validation. Bears see it as too far, too fast. Option strikes cluster there. Stop orders cluster there. Media attention clusters there. So price often whipsaws around it, even if the larger trend is up. The second line is support. In this environment, the market tends to step up supports, meaning yesterday's resistance becomes tomorrow's floor. If $75 is the ceiling, then the zones below, $72, $70, become critical. $70 is the kind of level that institutions love because it's clean. It's also the kind of level that gets hunted because it's obvious. If silver flushes to $70 and snaps back, that's a signal. Strong hands are defending. If silver slices through $70 and holds below, the market is telling you something different. The rally was more fragile than it looked. Then there's the prior peak zone. When a market has recently printed extreme highs, that high becomes a psychological checkpoint. Traders remember it. News anchors repeat it. Everyone stares at it. If silver has a known high in the low to mid 80s, then the path from $75 to that zone becomes the next objective narrative. And once a market is within striking distance, momentum funds can press the move. But here's where you must sound human and smart in narration. You do not promise the high gets taken. You explain what taking it would mean. It would mean the market is not just reacting to a headline, it's repricing the entire regime. It would mean the squeeze is overpowering profit taking. It would mean the next move could be less about charts and more about volatility expansion. Bigger candles, bigger gaps, faster reversals. That's what blow-off conditions look like. Now, let's break silver's current setup into 3 scenarios you can narrate cleanly. Scenario 1, the breakout continuation. In this scenario, the Venezuela shock stays hot, diplomatic reactions intensify, risk assets remain nervous, and economic data supports easier policy expectations. Silver holds above $75, consolidates briefly, then pushes toward the next major zone. In this world, dips are bought quickly, and every pullback becomes a higher low. The story becomes self-reinforcing. Headlines justify the bid, and the bid attracts more headlines. Scenario 2, the consolidation coil. In this scenario, the geopolitical story remains tense but stops escalating hour by hour, and the market shifts focus to the calendar. Silver chops between $72 and $75, shaking out late longs and baiting shorts. This is the market digesting a big move. It feels boring compared to the spike, but it's often the healthiest structure for a sustained trend. If you're building a 50-minute episode, this scenario is where you explain patience. The market is not dying, it's building. Scenario 3, the liquidation rug pull. In this scenario, broader market seize up, stocks drop hard, margin calls hit, and traders sell what they can, not what they want. Silver can drop fast, even if the long-term case remains bullish, because in a liquidity event, everything becomes collateral. This is where you remind viewers that silver is not a calm asset. It's a lever. It can punish both greed and fear. The key is what happens after the flush. If silver dumps and then rebounds violently, that's often the market transferring metal from weak hands to strong hands. If it dumps and can't recover key levels, that's when you start questioning whether the move was mostly narrative. Now add positioning. When silver runs this far, sentiment becomes extreme. You'll see $100 silver everywhere. You'll see influencers calling for moonshots. That's exactly when the market loves to humble the crowd. But extreme sentiment doesn't mean the trend is over. It means volatility is about to expand. And expanded volatility means 2 things. The upside can be spectacular, and the downside can be savage. Both can happen in the same week. That's why professional narration focuses on levels and scenarios, not predictions. Here's the clean way to say it. Above $75, momentum stays in control. Below $72, the market is cooling. Below $70, the market is testing whether the rally was real or just adrenaline. That's it. Simple, memorable. Now, connect technicals back to geopolitics in a way that feels money and empires. Empires don't collapse in one day. They fracture. They overextend. They respond to stress with force, and force creates resistance, and resistance creates cost. Those costs show up in currencies, in commodities, in debt markets. Silver is not reacting because it cares about Venezuela as a moral story. Silver is reacting because it's a barometer of systemic stress. When the world feels less stable, the premium on real things rises. And silver, sitting between money and industry, becomes one of the most sensitive gauges on the board. In part 5, we finish with the forward-looking map. The data calendar, what to watch in headlines, what signals matter more than noise, and how this moment fits into the bigger money and empires cycle, where power debt and hard assets collide. Now we bring it home with a watch list, because the difference between a viral episode and a high authority episode is whether you leave people with a map. So here's the map for the week ahead. Headlines, macro triggers, and the silver signals that matter more than your emotions. First, the geopolitical tape. Don't just watch one headline, watch escalation markers. Escalation markers are things like additional strikes, retaliatory threats, regional mobilization, sanctions expansion, oil shipment disruptions, cyber incidents, and diplomatic breakdowns that pull big powers into opposing corners. You're not looking for drama, you're looking for probability shifts. If those markers intensify, safe haven demand stays elevated. If those markers fade, the market shifts to macro. Second, the energy channel. Venezuela is intertwined with oil narratives, and oil is the inflation pipeline. If oil spikes, inflation expectations can rise even as growth fears rise. That creates a messy regime, stagflation anxiety. And stagflation anxiety is historically supportive for hard assets, especially when trust in policy gets questioned. Third, the central bank channel. Watch what the market prices, not what officials say. Bond yields, real yields, and futures implied rate paths will tell you whether traders expect cuts, pauses, or surprises. If real yields drop, metals get oxygen. If real yields jump, metals can choke temporarily. Fourth, the dollar channel. A softer dollar is a tailwind for silver, but the dollar can whipsaw in crises. So the signal isn't one day, it's trend. If the dollar rips and holds, metals can stall. If the dollar spikes and reverses, metals can surge. Fifth, the silver-specific channel. Watch premiums, delivery chatter, and the behavior of dips. In a true tight market regime, dips get bought fast and physical premiums stay stubborn. In a hype regime, spot runs, while premiums soften and pullbacks don't get rescued. You don't need to be a vault analyst to read the tape. You just need to watch whether the market is acting like scarcity or acting like speculation. Now, the economic calendar. The key releases are the ones that change rate expectations, labor data, inflation signals, manufacturing surveys. In a normal week, these are routine. In a crisis week, they become accelerants. A weak jobs print can intensify rate cuts are coming, which can boost metals. A hot inflation surprise can push yields up and smack metals, even if the long-term trend remains intact. The important thing for your audience is this. The market can punish you for being right too early. Silver can be bullish long-term and still drop 10% in a day. That's not a contradiction. That's the instrument. So narrate it like a pro. We are in a volatility regime. Expect violent moves both directions. The trend is the story, but the path is chaos. Now zoom out into the money and empires thesis. Empires are built on credibility. Credit. The word is not an accident. Credit is belief turned into leverage. And when belief gets shaken, the world reaches for things that don't require belief. Oil, food, metals, energy, hard assets. Silver is one of the oldest no-confidence votes in history, but it's also a critical material for the modern system. That's why it wanes so powerful in moments like this. It is simultaneously ancient and essential. It speaks to fear and to function. And when the world starts questioning stability, whether it's due to war, policy, debt, or all of it at once, silver becomes a mirror. A messy, volatile mirror, but a mirror nonetheless. So how do we end this episode with authority? We don't end by screaming targets. We end by framing the moment. Here's the frame. When geopolitics detonates, markets don't wait for clarity. They price risk. Silver at $75 is not just a price. It is a signal that the cost of uncertainty has risen. Well, then you give the audience 3 clean lines they all remember. Watch 75, control line. Watch 72, cooling line. Watch 70, stress test. Then you remind them what matters. Headlines can fade. Structure can remain. If the market is truly tight, silver won't just spike. It will hold higher ground. And then you land the theme. Every empire believes it, as is permanent until the ledger says otherwise. And when the ledger starts trembling, the world remembers what real money feels like. Final call to action, human and simple. If you want part 2 of this story, the deeper dive into the silver squeeze mechanics and the historical parallels, hit subscribe. Because the next move won't be decided by opinions. It'll be decided by stress.